Markets have rallied heading into the final trading week of 2023, just days left, with much of the optimism being put down to the dovish tone from the Fed, indicating around 3 rate cuts in the new year. S&P and the Nasdaq have clocked in highs not seen since 2022, tracking a 9th week of consecutive gains. Our next guest predicts this upside could last for several years, and has chosen some stocks which will specifically benefit from the predicted cuts to come. Let's bring in Thomas Hayes, Great Hill Capital Chairman. Thomas, I don't even know what I'm doing for the next several years here. You're anticipating stocks, and this could permeate, and this optimism could permeate for several years. What is the main catalyst? Because it can't be AI alone.
Yeah, well, this is what it looks like when 65% of managers are behind their benchmark. So we've had this huge year-end push. We've come a long way in a short period of time, and now consensus is we must correct in January and February. I think a lot of people are positioning for a 5 or 10% correction. I think the key is to zoom out, because if you actually look, we've had 0% gains since 2021 in the S&P 500. We're now just breaking out to new highs, and it's very hard to short new highs. So it wouldn't be surprising to see some consolidation in January, February, some volatility. But I think as you look forward, there are a lot of stocks that are just starting to participate that are at very low valuations that can perform over the next couple of years.
So what's the best strategy? Somebody watching this, they're seeing a market trade at record highs. Do you pour more money into NVIDIA, even though it's up, what, 237% a year and trading at record valuations? Or do you sniff around some of these doggy healthcare stocks that have had terrible years this year?
I think the latter. I think you want to look at relative value. Large cap is trading at about 20 times forward, maybe now a little bit more than 20 times forward. Small and mid cap are trading around 14 times forward. So that's where you're going to find the real value and the real opportunities. So I do think that, if you look at presidential years, the average since 1928 is about 11.28%. With a sitting president running for re-election, it's about 13%. So those companies that make up the heaviest weights will probably do okay, but much less well than they did in 2023. So I think you've got to look under the surface, and I do think there's going to be tremendous amount of money made under the surface, even if the general indices are only up high single digits, low double digits in 2024.
You mentioned going into a presidential election, general election year. What, amid what is anticipated to be a vitriolic campaign season that we're going to see next year, what could spook the markets? Is there anything that could throw us off course, especially given some of the concerns that we've seen geopolitically, or even where the Fed is going to perhaps have its own turnover as well going into next year, and where camps line up there?
Yeah, there's always something. I mean, we do have the geopolitical risk. We do have the Fed risk. I mean, you've got a wide spread between the Fed anticipating 3 cuts in the dot plot and the market anticipating 6 cuts. The Fed is still highly restrictive right now. If you consider where the Fed funds rate is relative to core inflation, you've got about 200 basis points of restriction. So they're going to have to close that gap. Maybe if we do see a little bit in oil, that'll help keep inflation a little bit above trend, and then they bring down rates modestly. That'll get us to a more accommodative state. But really, it's going to be a stock picker's market, and I think the real risk for the markets generally is not politics. It's if one party wins the executive, Congress, and the Senate, that's when you tend to get underperformance. As long as you have some form of blocking and gridlock, that's very, very positive for equities.
Like Brad mentioned, it could be a really volatile year because of the election. Are there certain stocks or names you think could just overcome this political rhetoric?
Yeah, there are a few that we really like, and they call me Turnaround Tom, because these have really gotten hit off of the recent highs in 2021. So you've got 3 turnarounds. Number one, you got PayPal that was hit 85%. You got Generac that was hit 85%, and then you got Crown Castle that was hit 55%. All of these benefit in their own ways from rates starting to normalize. My favorite right now is PayPal, and particularly because of a new CEO catalyst with Alex Chriss. Alex came from Intuit, where he ran the small business division. He was responsible for 50% of revenues, and over a 10-year period, that stock was a 35 bagger. So this guy knows how to do acquisitions, to do accretive acquisitions, to cut costs, to drive growth, and he's going to do that in PayPal. PayPal, his initiative is to turn it from a value stock. What do I mean by that? It's now trading at 12 times next year's earnings.
It's amazing to see PayPal trading at those levels.
Yeah, it historically traded at 30 times. Yep. he's going to turn it back into a growth stock. And the key thing that analysts have been very negative about why it got derated down to 12 times is Braintree is 10% of the global large enterprise processing. Think they've got Uber, they've got Ticketmaster, and the margins contracted. The size increased, but the margins contracted. That's starting to reaccelerate since Alex Chriss came in the last quarter or so. As those margins start to reaccelerate, you're going to see multiple expansion, coupled with rates lowering can help with that multiple expansion. And we think this one, despite the fact it's up 23% in the last few weeks, we think this can go up another 50% over the next 12 to 18 months.
Make Generac sound sexy, because a lot of people are wondering why you chose that one.
Okay, so Generac has the same problem that many companies coming out of the pandemic, whether it was Intel, many others, they overstocked on the basis of not being able to get enough parts, worried demand was huge. They bought at the exact wrong time at the exact wrong price. They've brought inventories down from 2 times normal levels to normalized levels in the last 4 quarters. And the consumer often finances it. So they've been a little bit stopped out with rates going up. As rates start to come in, you're going to see more financing. And this is a covert play on the housing recovery. As rates come down, you're going to see more and more supply of houses come back on the market. Their commercial and industrial business has been doing fantastic, up 24%. They back up some of the cell towers, et cetera, data centers, et cetera. But that residential needs to come back. Now that you've got the inventories through, I think this is going to be a great play for 2024.
Turnaround Thomas Hayes, Great Hill Capital Chairman. Good to see you and Happy New Year. Thanks for coming down.
Thanks for having me.
We appreciate it.